on what?
Cash flow.
Mhm. So, yeah. Fire company. I can't spell it. Cash flow. Not on the capital structure. And how many different versions of there was Moglen and Miller?
2.
Mm-hmm.
This tax or without tax?
Right, taxes, right, without tax, company tax, with company tax, without company tax, right? Mhm. 3 different versions too.
So it was 2.
Anything else on Moglen and Miller?
You put 3 different versions.
Hmm?
You put 3 different versions.
Yep, 3 different versions, right?
Tax, 2 tax.
Okay. First one assumes what? No taxes, right? Second one assumes what?
With tax,
Well, for who?
corporation.
Mm-hmm. And what about the third one?
Third one is
Hmm? First one?
personal tax?
Yep. Mm-hmm. No taxes for number 1. Company taxes for number 2. And for number 3, it assumes company and personal taxes. You've probably seen Moglen and Miller before, hopefully. Mm-hmm. Next topic is what?
Employee profit.
The advantages of it. What are some advantages?
Excess capital.
Access to capital, right? What else?
Liquidating.
Well, going public doesn't necessarily change the liability of the firm, right? Because you're still a corporation.
Yeah, but you get an extra cash from
Great.
it. You got to put out your money.
Cash from initial, right? Public offering. What else?
Book service. Great liquidating.
Liquidating, that's bankruptcy. We won't liquidate. It's, what is it good for?
Increasing.
Raising capital.
Hmm? What do the employees get to do?
Not sure.
They get shares that are what?
Liquid, they can sell them.
Mm-hmm. Make sense? Because as a private corporation, it's very hard to sell yourself, right? Very hard to sell this. They have shares in the company before it goes public. It's hard to sell. Some exchanges will do it now, but they have a rule, SEC is kind of picky about that. Usually the waiting period for them is like 6 months before they can sell it. Okay? Okay. Listing on a stock exchange. What is a stock exchange?
It's a common ground where normal public can trade in. It's a secondary market wherein the normal public can buy and sell the shares. Right.
So what's the goal of the exchange?
Mm,
Buyers and sellers together?
yeah.
and sellers together. Okay. Is a common place or website nowadays, right? New York Stock Exchange, NASDAQ, things like that. What's the advantage of a stock exchange versus not being on a stock exchange or listing? If you say you're listed on New York Stock Exchange, does that bring you any, a little prestige maybe? You're viable? Because the exchanges have what, certain parameters for you to be listed on that exchange. So as soon as you know they're listed on the New York Stock Exchange or the NASDAQ exchange, you know they satisfy certain capital requirements, certain balance sheet requirements, earnings requirements, not as much anymore. Before Netscape went public without making any money, there was, used to have 3/4 of earnings before they would take you public. Now, they'll look at your balance sheet. Are you viable? Okay? The big exchanges, talking NASDAQ and New York Stock Exchange. Okay? What's a private placement? And who gets it?
Bond issue that is sold to small group of investors.
Small group. Sometimes they're called 144A deals. They will call them qualified investors. Certain capital requirements that they have to have. Most institutions would be considered qualified investors. Individuals, I believe the capital requirements are you have to have at least $1 to $2 million of net worth outside of your home. So not counting your home as your asset, you have to have assets worth that to be qualified investor. Okay? Private placement, selected group of investors, qualified. Okay? Can be a person or an institution. Institution, much easier to be a qualified investor because of your size. All right, lease calculation. Now let's start going through it here. What do we have? We have what? Potential lease, right? We got 4 years. What else do we have? What does the machine cost? $50,000, right?
Yes.
How long is it going to last?
For
What is Makers? Modified accounting cost recovery system.
yes.
And that is, what do we need Makers for?
For depreciation.
That's your depreciation calculation, right?
Uh-huh.
Who uses Makers?
What do you mean?
Hmm?
Like, what do you mean, who uses it?
IRS.
IRS, yep. Mm-hmm. Do we have to use Makers for our books with the SEC? No.
No.
Straight line.
We use straight line, a bunch of different methods, right?
Mm-hmm.
But for tax purposes, we have to use Makers. So there's really two separate sets of books on depreciation. One's for taxes, one's for the SEC. SEC has like 3 or 4 different ones that they'll take. Okay. All right, what else do we know? So if we did buy the machine for 8, it would be an 8% loan rate, right? What else? And be amortized over the 4-year life. Okay, we know that. The loan payments will be made at the end of each year. The machine will be used for 4 years, even though Makers says we're going to depreciate it for 3 years, right? At the end of which time will be sold for an estimated residual value of $5,000. So $5,000 residual. So if we buy the truck, its after-tax cash flows would be the following. And this is not here. Here, 1, 2, 3, 4. And we have what? 6250 negative, right? Year 2 we have,
5,750.
it's negative, right?
Uh-huh.
That's 5750. Year 3 we have negative 4800, and what else?
Negative 7,200.
So what do we,
Last week.
all the occurring in the respective years? Okay. So that is what? After tax, right? See that? After tax cash flows. So what are we trying to calculate here? All at the end of the year. The lease terms call for a lease payment of what? Beginning of each year, how much? Does it tell us? It says lease terms call for a lease payment for payments total at the beginning of each year. Okay.
So we use the payment formula.
Mhm. So, formula, financial, payment, right? What's our rate?
8%. 4.
4 years?
Minus 50,000. 5,000.
So what is that? Is that my lease payment?
Yes.
Or is that my loan payment?
I think that's loan payment.
That is, no, that is loan payment.
Right. So this is my loan payment. Right. Now, how do we calculate for the lease?
Can you show me your input again for the
Sure.
payment?
There you go.
Okay.
They gave us 8%. They told us a 4-year life, negative 50,000, that's what we're paying for the machine. $5,000 would be our residual value. So the lease calls for a lease payment at the beginning of each year. And at the beginning of each year, the tax rate is 30%.
So lease payment would be 50,000 minus 5,000 divided by 4.
And then you put 1.
So, we're going to use 8%, we're going to use 4 years. Okay. Who's the residual value for?
The owner.
The person that leased you, the lessor?
No, the dealer.
So the vendor from whom you leased it,
Okay.
so you don't get any profit from the residual value because you are
Correct.
the leasing.
So should we put 0 for our ending value then?
E-
If I'm leasing it?
Yes.
What else will we do? These are made at the beginning, right?
Mhm.
So we have to put a 1, right?
Yeah.
Okay? 0 or leave it blank for end of period, all right? Ooh,
What,
didn't make a difference at all.
how you get 30,977? 0? I mean, if we don't have residual value, if the residual value is 0, then repayment is at the beginning.
Does residual value matter toward me if I'm leasing something?
No,
No.
it's only if you're buying.
Only if I'm buying it. And what about taxes? How do taxes look into this?
That would be 30% taxes.
Say it again?
30% because that was the tax rate, right?
30% of what?
The lease payment. Or is it the owner?
Yeah, 30% of the payment. So it would be, even for the loan payment, you are getting 30% tax benefit.
No, not for the loan payment. You get it for the loan payment?
What's my interest well, what's the interest expense going to be for the loan payment?
So interest expense. So either we can take that 8% or we can just simply take the tax and calculate the loan for that particular interest, tax-free interest rate.
So how would that affect my after-tax cash flow?
So your after-tax cash flow would be higher.
If I did,
If you calculate in the tax rate. So you'll be paying less amount, so your cash flow is higher.
so this is after-tax, right?
Okay,
Right. So does everybody understand, or no? Yeah? No? Yeah? Margaret? Where's the lease payment going to be in my structure, in my income statement?
It's your expense,
Right, what kind of expense
operating.
though? So what's that going to do to change my cash flow?
Nothing.
So if I'm saying this is my operating expense, right?
Mhm.
Will lower your taxable income.
By the loan amount, right?
Yeah.
Lowering your taxable, yes, so more cash is in your pocket.
What about the that's for a loan, what about for the lease?
Oh, wait, I thought that we talked, that was for lease.
This is for lease, okay,
Lease payment, that's an operating expense.
correct.
And for loan, you will have an interest expense as well as the depreciation
Mhm.
expense.
So what's going to result in a better situation for me?
Probably loan.
What do we say about loan interest?
Loan
Tax
interest is
deductible.
tax deductible.
Lease payment?
Mhm.
So my operating expense for my cash flow, this would be my lease, right? How would that adjust to my cash flow? Higher, lower? Kind of hard to tell, isn't it? Right? This is my lease. Let's do one for loan. I'm going to have 2 lines, though, of expense for a loan. What am I going to have?
Depreciation expense and interest expense.
And have depreciation as well as what?
Interest.
Mhm. So in theory, this one reduces what? My net income, right? Okay. So I have an interest expense, which would result in what? Actually, let's do the interest expense down here. And then what's my depreciation? We'd have to look up a 3-year machine on the maker, right?
45 divided by 3.
Say it again?
45 divided by 3 years.
3 years?
Yeah,
Well, for a straight line, right?
everything's straight, okay.
But if we did makers, that's a percentage of each year, right?
Yeah. We will have
Whatever
to use
that
a
3
table.
years. Mhm. So 3 year would have to give me, which would give you the problem.
What's the final exam example?
Hmm?
That's like a similar to final exam
What?
example than what we're doing right now.
Yeah.
They require us to use the makers tables.
I wouldn't go that far, but
Okay.
I just want to show you how what it would be.
Just like that.
But it definitely makes a difference. There, there's your makers. So, I want that one. Makers, that's your depreciation.
IRS.
I don't know, I don't want to go to the IRS. Makes me nervous. Every time I go to the IRS website, I get those stitch. So, for example, if we were using makers, year 1, take the total amount, multiply it by that 33%. Year 2, take that total amount. Year 3, year 4. Okay? Why they do that? Why did they pass the CPA? I don't know. Right? Mhm. So depreciation would be, then times what, 33.3, right? And so forth on the line. Which would be cheaper? Considering taxes.
Loan payments would be cheaper.
Loan payment would be cheaper because we have depreciation and we have interest expense. Correct? Understand how to calculate these? Payment function Excel, payment function Excel, yes? All right, what's next? Interest rate parity. Read the homework. Any questions with that? No, no. I'm just teasing.
I'm still in there.
I'll send this to you.
What is this question? Should the form lease or buy?
Mm-hmm.
What exactly?
We should buy because we have depreciation and expense reductions, right?
Which number you compare?
What, is my loan payment more than my lease payment?
No. Yes.
You loan payment more, just a couple dollars.
This is just calculating the payment, right?
Right.
But what else do I have to take into consideration? Depreciation, and what else?
Interesting.
Interest expense. It's going to make my after-tax cash flow higher than if I just do the loan, because there's just the operating expense.
So for the interest expense, wouldn't you calculate that using the INT formula compared to the payment? Because in this particular scenario, payment for the loan would make capital and the interest, or the principal and the interest.
Amortization table
Right.
for a buy agreement? I don't think that we assume amortization. Do they assume it or no? I would not, the loan would be amortized, you're right. So that would be capitalized over, or done over 4 years. So if you calculate this way, what would be the difference with amortization?
Because your interest expense would be much lesser.
Right. But you still have interest expense and depreciation versus just an operating expense.
Right, the answer will remain the same, that loan payment is going to be cheaper. But in this scenario, the amount that you are calculating as part of the depreciation is going to remain the same. The interest expense would reduce.
Mhm. So if we had amortization schedule would look like what? Mhm. We have 50,000 first year. What do we do?
So amort linked,
This is my principal, right? We're assuming annual payments, right?
Yep.
At what interest rate factor?
8%.
Mm-hmm. So what's my payment gonna be then?
So payment, you have calculated in B11 already.
Mm-hmm.
That is the total payment, right?
Okay. Does it matter for the lease payment though?
No,
What does it matter for?
it matters because of the interest expense, because we can only take out, or we can only deduct the interest
So for loan payment?
for the loan payment.
Mm-hmm. What would be, now what do I compare this against?
That interest expense would be lesser, so you will take that, so the interest expense times the tax rate.
This
is-
payment?
Sorry,
How do you break it down if you're gonna do that? I don't wanna go too far into this, this is really part of what we have to solve here.
Yeah,
okay,
Okay?
okay.
But you're on the right track, though. That's how you would do it with your books, absolutely. With interest expense. Questions on the interest rate parity?
So is all that's filled in, that's all correct?
Except for just your comparisons are here for
Uh-huh.
the payments, and then with depreciation and interest expense, what would be better? Loan payment. Right?
Got it.
but do we have to show you the depreciation amounts each year, calculate all of them?
Yeah, that's what I was wondering, the depreciation.
It'll be the same format like you've been seeing, so the ABC format.
Okay.
So it'll show you the answer, what they're looking for.
Oh,
Depreciation and what else?
interest expense.
Interest rate parity. What is interest rate parity first of all? What does it mean? What's the difference between two currencies? According to interest rate parity, what is the difference between two currencies, values? It says it in the formula. It says it in the thing. It says interest rates. The difference in the strength or weakness of the currencies should be determined by
The interest rate.
the interest rates of each currency, right? So, we have an interest rate parity that says 90-day investments. Britain has a 5% annualized return. United States, 90-day investments have a 4% United States percent annual return, 1.5% quarterly. In a forward market, 1 British pound equals $1.60. What should the spot exchange rate be? What do they mean by spot exchange rate?
On top day?
Today, right?
Mhm.
Today's spot price, and they're quoted 90 days in the future. So, we use British pound, GBP, and what's their 90-day rate? 2%. What's the USD's 90-day rate?
1.5%.
Okay. Is there a 90-day rate for both, right?
Mhm.
What else do we do?
Forward rate.
What's the forward, well, what's the forward rate? What does it say?
$1.
One,
1.6
no,
US dollar equal to 1 pound.
no.
Yeah,
It says 1 British pound equals what? 1 GBP equals what?
1%.
Okay. USD, right? I won't deal in this terminology. And what are we looking for?
Spot rate.
Okay. What's the formula for interest rate parity?
Forward rate equal to spot rate times.
Oh, look at you. Somebody did some work.
Yes.
Times what?
1 plus US rate divided by 1 plus foreign currency rate.
So what do we know?
We know F,
1 plus what?
1 plus
0.015, right? Divided by 1 plus what?
0.2.
What we don't know is what?
Yes,
What's the forward rate?
1.6.
1.6? How do we solve that? Oh, it's algebra. I don't want to do algebra.
1.6.
Well, let's see.
Good question.
Let's see if this makes sense first. So we have 0.15. We have equals 1 plus 0.02. And we have a forward rate of what? 50 USD. We're missing the spot rate. First thing you do is what? Divide those two, right? Divide this. US 1 plus USD rate, 10.9. Now, what do I do to solve for us?
Divide. Divide by 1.6 divided by 0.9.
Mhm.
Same.
Take out 2 decimal places because currencies are usually out to 4 decimal places. Now, does this make sense? Oh, I knew that. God asked me that question.
Other question.
What should happen if the interest rate of the British pound is higher than the interest rate of the US dollar? According to interest rate parity, what should happen? Should the rate be higher or lower than the 1.6? How many say higher? How many say higher?
You mean British rate?
Yeah,
Should be higher or lower?
should be higher.
Yeah.
Higher?
Yeah.
1, 2, hires.
You
3.
mean,
Should it be higher than 1.60 or lower than 1.60 based upon the interest rate relationship?
is British.
Which interest rate's higher?
Right now is British.
That's
Wow.
90-day forward rate, right?
Uh-huh.
So that tells you that what should happen in the future.
The pound
The
should.
pound should get stronger
Uh-huh, maybe the lower.
against the US dollar. Did it?
Mm.
1 pound bought me how much?
1.6.
What happened here?
The pound dip.
So it went from 1.6079 today to 1.6.
In the future.
Weaker or stronger?
Weaker. Because I need more dollars today to buy it compared to that in the future.
Weaker or stronger?
So pound is weaker in the future because today I need 1.607, so $1.61 to buy
1
one
pound buy me 1.607, right? In the future, 1 pound buys me 1.6. What happens? Pound get weaker or stronger?
Pound is weaker. Pound gets weaker.
Does that make sense with interest rate parity?
No, the pound should go higher, right?
You think.
Can I see your spot rate calculation?
Sure. I took these two, divided these
Yeah.
two down here.
Yeah,
Then divided it by the 160.
okay.
That's your answer. Just want you to think of the theoretical too. Purchasing power parity. That means a Big Mac here should cost the same as it does all over the world. That's what they use in the Economist magazine. Does that work out?
No.
Why not?
The dollar values are the same.
Hmm?
The currencies are the same.
That assumes that currencies are, yeah.
Which it is, because the dollar here. is
No,
not
they,
the same as
they
Russia.
used to compare the PPP to compare different countries.
Mm-hmm.
So like, how costly is it living in US compared to living in Japan? So at that time they used the PPP for comparison.
What are reasons why this wouldn't be work?
Inflation?
Inflation, interest rate.
Okay. The example that they use with the Big Mac. Big Mac gonna be cheaper over here than in a foreign country? What about a developing country? How are you gonna source it? How are you gonna get the items there, right?
It is cheaper in India.
They use chicken though.
It is cheaper.
Chicken is a Big Mac, no meat. So purchasing power parity says an item here should be the same all over the world. Is that true?
No.
No. Inflation's a big thing, and also it depends upon the item too, right? You think it's easier to get hamburgers and potatoes and everything delivered here, or over in Japan,
Yeah.
right? Make sense?
Or even Alaska.
Okay. Residual dividend policy. Oh my gosh, that's way back, huh? Mhm. So we have a capital budget of what?
600.
Which problems are you looking at this?
Just use different amount.
What?
Use.
No, that's discussion.
What was it again?
We had 600,000 is our budget. What is the capital budget? What does that mean?
That,
Think of it as capital investments, right? That's the money we're gonna invest back in the company. It says, the CEO says we wanna be 40% debt, 60% equity. And he wants to pay $400,000 in dividends. Residual dividend policy says what? I will pay anything in dividends after everything else is paid, including capital investments or capital budgeting. So what's the question? Ask. How much income?
So we multiply that with equity and add it to the dividends.
Okay. Because 60% of our capital structure is dividends. So dividends are only paid to equity holders, correct?
So first we take that particular, so that 60% out from the capital budget. Sorry, the debt. We take the debt out of the capital budget.
Okay,
So here's what we're looking for. Bottom line net income, right? We know that dividends are going to be what?
400.
My capital budget.
So how much is needed? So you need,
No, equity is 60% of the capital budget.
Okay.
So that is 316,000. Then plus the dividend will be net income
So you want to multiply the capital budget by what?
for 60%.
360.
add the dividends.
And add the dividends of,
400
to get net income?
to get net income.
Why dividend?
Yeah, that's the net income in order to get a 400 dividend.
No, we're paying the dividends out of the active, not net income.
But on your income statement, where does it come from? Dividends are after net income?
Yeah,
Yeah, the shareholders equity, whatever it's left, like accumulating.
No?
yes,
Positive?
after.
I like it. It's a calculation, right?
Yeah,
But why 60%? That's the question.
because the capital structure companies keep 40% debt is 60% equity. So the total capital budget is 600, the equity will be 360.
So equity will be financed, no, debt
Yeah,
will be
the
financed.
dividend is in order to get the 400 equity.
I get that, but
Then the company need to make 700 income, then
No, I get that part, I'm just saying the capital budgeting side of it. Why is it 360?
because it's 60% equity. This is company structure, capital structure.
Maybe it's the right way. Bonds pay dividends or ABC ratio of how much the company must earn for over its dividend payout. Yeah? No?
I think it's right.
She's right?
Mhm.
Well, Matt says she's right anyway. I have no law here today. Now, what's the dividend payout ratio? How's that calculated?
Ratio 400 divided by 760.
Mm-hmm.
That's the ratio.
I just like to start fights, that's all. Sorry. All right. Warrant. Now, what's a warrant? What financial instrument is a warrant like? Well, answer at once.
Bond?
No!
Talk about that question number 9,
Mm-hmm. What's a warrant?
warranty,
No! Warrant's like an option.
the right of the,
Mm-hmm. The difference between a warrant and an option is warrants are usually given as a sweetener in a bond deal. Okay? So, here's a bond deal. 30-year maturity. Why? 37. Yeah. What else do we know? $25 warrants. What is a bond? What's the normal value we use for a bond? What is it traded? What they cut increments? Mm-hmm. Usually $1,000 increments, right? What else is this telling us? Each bond will come with 25 warrants that give the holder the right to purchase 1 share of stock per warrant. Okay? 25 warrants would equal 25 shares. The investment bankers estimate that each warrant will have a value of $10. A similar straight debt issue would require 8% coupon. What coupon rate should set on the bond warrants that package would sell for $1,000? Higher or lower? If I were to do the straight deal, how would I figure it out? Not straight down. How would I do that? When I'm calculating bond price, what do I use?
which is
Which function?
coupon,
No, which function?
present one.
Okay. Now we know if it's at 8%, the bond's going to sell for what? $1,000, right? Now if they estimate that the warrant is going to sell for is how much? Mm-hmm. So the warrants together would have a value of what? Mm-hmm.
Coupon.
Now what coupon, how is that going to affect the coupon rate we set? How many years?
30 years.
Payment, do we know payments?
The 18 coupon rate.
That's what we're looking for here, right? This regular bond said 8%.
Regular bond is at?
It's 8% coupon rate.
So then we should take 18 as the payment. Right?
That's 80.
Okay, so you're saying 1,000 times what?
8%.
Present value, so the price of that car, right? What about future value?
So what are we calculating here? Are we calculating the
Rate
150?
of the bond with the warrants.
Future value is 1,000, right?
Why is present value is 1,000? Supposed to be 1,000 is the future value, right?
no.
Plus what?
So present value and future value will still be the same at 1,000.
What about the warrant?
No, the 250 is like this.
In theory, I'm gonna get, I hate using the word in theory. If it works out well for me, I will get what at maturity? $1,000 plus what?
200. That's the rate
So
function.
25 times 10, so that will be 250. So we have added 1,000 to 250.
Household look, don't care what. Wanna go home look?
So from where are you getting these questions? Like these are the homework questions or?
You've seen them before, unfortunately. But these are the final exam questions. Did I send you guys the final exam review? What emailed you last week?
It was in the dark sharing.
I emailed it to you last week.
Yeah, on June 11th, I just put it,
Oh,
I
okay.
just put it.
Okay. My return should be greater with the warrants, all right?
Well, most of these questions are our discussion questions, too.
Mm-hmm.
They were from the discussion.
Mm-hmm.
Can you scroll just to the net income dividend line, just a couple lines up there?
Yes, the net income and dividends, yes.
Thank you.
Mm-hmm.
Are you gonna email?
Yeah, I'll email this out to you guys, so.
Can
Yeah,
you-
I think, yeah.
Thank you.
You
May I
said
ask
you'd
you
email us
one
the
more
questions?
question?
No, we got a bunch of stuff to do yet.
He
Oh,
already
okay.
did email
The
the
rest
question.
of them just concept questions.
week.
Yes.
Well,
Must have
those
missed
are
it.
too quick.
Calculation.
Please.
So
Bankruptcy, what kind of bankruptcies?
Chapter 7, chapter 13.
Legal.
Oh, not 13. 11.
Oh,
What's the difference between 7 and 11?
Chapter 11 is reorganized thing.
Most bankruptcies are reorgs, chapter 11. Chapter 7 is?
It is liquidation.
Right. Okay. Even if you start out as an 11, sometimes you can wind up being a 7 if they can't restructure it, right? Capital structure debt. What would be the, given that we have interest expense deductions, right? For bonds, for loans as a corporation. What would be the ideal structure of a corporation?
the structure of the corporation.
All debt.
All debt. Is that practical?
No.
No, because the more you get, the more.
The more debt you add, the more expensive it gets, right?
This is a 11 capital structure debt.
Mm-hmm.
What, do we have calculation? We don't have calculation, right?
You don't worry about the calculation. Recapitalization. What does that mean? Recapitalization,
Mm.
what does that mean?
Form makes a significant change to its.
Oh, you're reading.
What is the question for capital structure debt?
What's the question? You didn't listen to me, you were busy doing other things. We talked about it.
Sorry.
Mhm.
What's the,
Go ahead and read your recapitalization.
when a firm makes a significant change to its capital, the transaction is called a recapitalization.
Recapitalization, we change our capital structure. How do we do that? We want more equity. How do we get more equity?
Issuing more bonds,
No,
no, issuing more
issue more stock.
stocks,
With the payment from the stock, what do?
finance.
What do we do with the bonds? We can buy back some more bonds, make it even more drastic, right?
Repurchase bond.
Recapitalization, changing the capital structure of the firm. We already said chapter 7, chapter 11. Forward rate calculation. Let's talk about synergy and horizontal mergers. What's a horizontal merger?
That's when you get an example of fuel company, fuel and then an airplane company.
They're merged in the same. industry.
Horizontals in the same industry.
Right.
So like two airline companies would merge together, horizontal. What does synergy mean?
The amount that they are going to save because of the merger.
People get
Fired.
exactly. What's a vertical?
Different
Mhm.
Vertical would meaning an airline company,
Acquiring
oil, airline company acquiring a travel agency, that kind of thing. Okay? APV approach, what is the APV approach? In a definition term.
approximate present value.
Mm-hmm.
Approximate present value
Mhm.
is,
What is that approach though?
so it will take into consideration all the
Financial benefit.
tax implications.
Mm-hmm.
Because when you get the present value, you're not calculating benefits or loss because of the taxes.
Mm-hmm.
So APV takes into consideration for the tax value.
Okay. Anything else for APV approach? Okay. What? Why are you laughing? Huh? Oh, you're laughing. Why? Tell me.
No,
No, tell me.
for one,
No, tell me. I'm serious. Tell me.
nothing, just,
About me.
no, just,
She was honest, she didn't know it.
I don't know what is,
Nothing.
yes. APV, for my notes, is net present value.
Entry is not present value. You see that in your notes or in the notes I gave you?
The notes you didn't give to me. I found it by myself
Okay.
online.
Okay.
That's-
The notes I give to you, you'll see a definition for APV. Okay.
That's the adjusted present value, right?
Mm-hmm.
See?
Adjusted, not net, adjusted for the value. But actually look at the form of the calculation and see what it means, what it includes.
It says the net present value of the project is financed solely by the equity plus the present value of any financial benefit. That's the debt.
Yeah, I got to say, what you need is by taking into account the financial benefit, APV includes tax share, such as rent
Common-
provided by deductible interest.
Common stock,
Security,
equity,